Hello everyone and welcome back to the channel and I hope you guys are doing great. In my today's video, I'm going to discuss with you about EFCI Limited, their recent result and their main points from con call. So we'll just go through it, right? And before and over here also, right, I will ask. There was some questions raised about the demerger which is not happening, then demerger which is happening. So there was a question asked to me, Masood, what's your point of view? So I will discuss that at the end of the video. So please stay till the end of the video to know everything. So if you look it over here, right, about EFCI, right? So I'll just spend some time in explaining the business model of EFCI Limited currently, right? So EFCI is into leasing, is into design and build and furniture. So if you look at the chart over here, right? So in terms of leasing, we all know what does that mean. So they either take offices on lease or buy those commercial offices, and then rent those offices out to various companies. Then design and build is the side of their business where they design, they have contract manufacturing with various clients where they design their offices according to their plan. And the furniture is the one which, manufactures the furniture and provides it to all the offices. So that's their whole business model. So in short, so if you look at their revenue, right, they did quite well. Their revenue grew by almost 29% YOY, to almost 282, sorry, 282 crores. EBITDA grew by almost 20% to 123 crores. And if you look at the PAT, right, compared to your last year, it grew by almost 52% to 70.9 crores. And if you look at so this is the overall revenue. And if you look at the revenue as per their segment, right, which I spoke about, which is leasing, design and build and furniture, right? So the leasing business, which is their main bread and butter business, grew by almost 26% and contributed a revenue of around 153 crores. If you look at design and build, it contributed to a revenue of almost 100 crores and grew by around 19%. So over here, if you listen to the last management call, right, the management said that this segment should grow close to around 50 to 60%. So we'll see what the management said on the call, because over here, if you look at quarter one, right, it grew by only around 19%. If you look at furniture, it contributed to the revenue of around 28.6 crore, which grew almost 124%. And that was expected because when they took up this manufacturing facility and when they started it last year, the capacity utilization was very, very less. So as the capacity utilization is picking up, the revenue is also picking up over here also. So if you look at their consolidated profit loss statement, right, I'm just going to go through over here. It's mainly to look at the margins. So if you look at the margins over here, right, so the earning before interest and tax margin is improved from 35 to 39.5%. If you look at profit before tax, the margin is improved from 30 to 35.8%. And if you look at PAT margin, it has improved from 21.3% to 25.1%. So over here, right, just give me a minute. Over here, the only thing that I want to discuss with you is about the earning per share. So over here, even though everything is going well for AFCI, right, the challenge is with their earning per share. So if you look at their earning per share, the earning per share did not grow much from last year. It grew only by around 15% from 4.05 rupees to 4.66 rupees. And one of the main reason is why, right, even though their revenues are increasing, profit is increasing, they obviously, for the growth of the business, they are raising more equity and they're diluting the share, and because of which the number of shares are increasing, the earning per share has not increased at the same level, and that is one of the biggest challenge for the shareholders who are holding this company. And if you go further and look at their how their the revenue portfolio looks, right? So if you look, as I told you, right, as they have three business model, which is one is leasing, design and build, and furniture. So leasing is their main bread and butter. And if you look at this chart at the bottom, right? If you look at the contribution of rental revenue, if you look from the long term perspective, it was around 19%. And if you look in the past 2 to 5 years, it was around 54%. And in the last 2 years, it has come down to around 27%. And one of the main reason it has come down is mainly because of the growth of design and build segment, and obviously the furniture segment coming into play. And if you look at their rental revenue mix, right? So because they have different clients to whom they rent out these offices and everything, right? So this pie chart helps us to identify how their customers are from different sectors. Because if they're concentrated in one sector, then it could be a challenge. So if you look over here, 35% comes from IT, technology, and software development. 15%, sorry, comes from business consulting and professional services. 29% comes from FMCG and edutech and all this one. So if you look over here in their leasing services also, right, their how to say, their rental revenues diversified across various sectors. So even though one sector has a downturn, or they might not be taking much rental spaces, the other sectors will still keep contributing. And if you look at their revenue mix, right, as I told you earlier, their main thing is, their main bread and butter is leasing, then design and build and furniture comes. So we'll see how the evolution has happened. So if you look at this chart on the screen over here, right, in FY24, leasing contributed around 62%, which has come down in 25 to 57%. And if you look at 26, it has come down to around 52%. And if you look for design and build, it has increased from 27% to 40% to 42%. And if you look at furniture, it has grown to almost 6%. This clearly shows, right, their dependency on their leasing business is reducing. The design and build is growing, and the furniture business is also growing, which is quite a good sign, if you ask me. So this was these are the main things which I've taken from the investor presentation. And if you look from the con call perspective, right? So I'll just take you through the main commentary which the management gave about their three main business, which is leasing, design and build, and furniture manufacturing. So they clearly said that leasing is still their main source of income. And over here, they're 100% confident that in FY27 they're going to add another around 18,000 to 20,000 billable seats for this year. So that will be the growth for them, so which is around close to around 20 to 25%. And if you look at the design and build system, they made some statement. First of all, they said that this business is contractual, and generally the quarter one is the weakest, and it starts picking up in the next quarter, and quarter three and quarter four are the best quarters. And they clearly said that the guidance that they're given, that this sector this segment will grow by around 50%, is still on track. So there are no changes to it, so which is actually quite a good sign. Because when I looked at the growth of design and build for Q1 FY27, I was wondering, okay, they how to say, they targeted for 50%, but they grew only by 27%. But with this information from the con call, right, this clarifies it up. And if you look at the furniture manufacturing, which is growing quite fast, the management is saying that we should not compare the quarter and quarter margin comparison for furniture segment as of now, unless and until they reach 60 to 70% of utilization. Once that is done, then the comparison makes sense. Otherwise, at this point of time, one should stay away from it. And in terms of margin target for the furniture business, the management said that it's going to be around 25%. So this was their main comment. Rest all in terms of numbers I've already discussed with you. And the last thing that I want to discuss is, right, about the recent demerger news which had come up, right? Because first the announcement came on 29th of July, where it says that, on the demerger, where they are not going ahead with it, which included various entities. Then another announcement came on 29th of July. I'm just going through it, where they spoke about another demerger, which is going to happen, right? So this created a lot of confusion among people, because I got a comment asking like, Masood, can you explain this? What is happening? Because I'm completely confused, not knowing what is happening with the business, right? So what I could understand from the documents that has been given over here. So the first demerger, which they did not go ahead with it, it include multiple various entities. Quite a few were there. You can go ahead and check the announcements over there. Then in the second one, the second announcement which came, where they're going ahead with the demerger, includes only one of their one company, which is called EFC Limited. So over here, right, I made some notes, so I'll just go through it and explain to you what is happening and why are they are doing it. Okay, and if you want, you can go ahead further and read into it, right? So what has happened, right? What the management had decided, right? They have decided to separate the asset light managed office solution business of EFC Limited from the main business. So in the simple term, if you look at it, right, they're trying to split the leasing business into two parts. First business one is asset light business, where they operate lease commercial offices. The requirement of capital is quite less, and they can grow much at a faster rate. The second part is asset heavy business. Over here, what happens? The company is owns these commercial real estates. It is capital intensive, and this generates rental and managed workspaces from own properties, right? So this is the difference. So this is how they are trying to differentiate. They are trying to demerge it. And why EFC is doing this, right? So what the management said, right? They want to separate the leased offices business from the loaned real estate. So currently, if you look at the leasing revenue, it includes both kind of businesses where they have taken the spaces on leases and the offices which they literally own. So over here, they want to separate these two businesses into asset light business and asset heavy business. So what will happen is, right, they're saying that it will allow each businesses to pursue its own growth strategy. It will improve operational focus, and the financial performance of each businesses, will be quite different, and the investors will be able to evaluate. So this is what the reason it is doing it, right? And the another thing which they informed over here, right, that the company which is the subsidiary which is being demerged, right, and if you look at the FY26, it generated a revenue of around close to 362 crores. And if you look at the overall revenue which they had generated from the leasing business last year, was close to around, I think, around 500 crores, if I'm correct. So out of that 500 crores, 362 was from this asset light business. And if you look from the overall contribution to the overall revenue for FY26, it contributed to around 35% of the revenue. So this restructuring of the demerger which is happening, it's just not a small one, it's a big one, because once this demerger is happened, one third of the revenue which currently EFSI is going to generate, it's going to go to a different company. So over here, now the question comes, right, will the shareholders receive new shares, right? So if I look at the latest announcement, right, so the board has approved the scheme of arrangement which is for the demerger, but related to what the current shareholders will receive once this demerger happens, that has not been how to say declared over here completely at all. And obviously for this, they have to go through NSCLT, to regulator, stock exchange, and everything before these things come into picture. So that information is not there. So right now, the current information what we have is only about the demerger, where they are, from the leasing business, they are separating the asset light business where they lease its offices and then rent out. So, and in terms of how much share or portion the current shareholders will receive, that is not there at all. So, so now the question comes, right, whether this demerger is good or bad, right? So we can look from two different perspective how things will pan out. So I've written down some points, right? So if I look at the potential positive which can happen, right? So what will happen for us as investors or analysts, right? We can evaluate separately the asset light model and asset heavy business, so we know what is their margin, what are they growing at, what rate that they're going rate. Capital allocation might be different, and management accountability becomes greater. And what we need to watch carefully, right, is these things, right? See, what is the valuation that they are doing during this demerger time? What is the ratio of share that the existing shareholders are getting? Whether any third party related concerns are there, and obviously what is the debt allocation that they're giving it to it, right? And the reason I'm putting this point, right, is you need to understand. Now they're separating the asset light business from asset heavy business. So obviously, asset heavy business would have taken more debt in order to grow their business compared to the asset light business. So when this demerger is happening, will they be fair in terms of how the debt is getting restructured, or will they try to push more debt to the asset-light business because they can generate, they might have better margins and better revenue and they can pay it off, or whether they will be, honest enough in ensuring that the debt which is taken by the asset heavy business remains over there. So these are the main things. And another reason why people might be concerned over here is that because of the White Hills merger, which the company did in a couple of years back, there were a lot of questions which would arise, and especially the main point which was raised, I have written it down over here, is right, when the merger happened, right? For every one share of Whitehill merger, 77 share of EFCI was given, which automatically what happened diluted the shareholding of the investors, which the small the investors did not like it, because imagine currently a company, I'm holding a share of a company which is worth 1 rupee, and then suddenly it increases by another 77 shares, then automatically my share is diluted by 77%, which, 77 times, which was a big problem at that time, right? So over here also, that would be one of the concerns for the investors, especially who have dealt with this company before. So we need to keep a close eye on this demerger. But in short, if what they are trying to do, it works out and everything goes well, then it could be a good thing, because we need to understand the asset light business market evaluates different compared to asset heavy business, right? So it could, how to say, unlock the value which the asset light business is currently holding. So if you guys like this video and the analysis, please do hit like and subscribe to my channel. Thank you and God bless.